Welcome to Power Charting. I'm your host, Bruce Frazier, and we're going to do another in a series of Wyckoff workshops, this one on the anatomy of distribution. We're going to build a body of these workshops that we can have available to us to be able to reference as we go through time, and we cover different market conditions in real time. We can look at a workshop on reaccumulation and refresh our memory. We can do a workshop on accumulation, refresh our memory with these videos. And so we will continue in the next number of weeks to months to build this collection of workshops, and we will also add to them with more advanced topics as time goes on. So I really look forward to that. I think of our being here together as being in the classroom. I loved being in the classroom. Hank and I did this for over 30 years. And being in the classroom, having students there, willing, motivated to learn, was a great experience. And so I've had these discussions, done these lectures over and over and over, and I want to, in my mind's eye, see you in the classroom and be thinking about what your concerns and questions are in the material that we're discussing. And so that's going to be my mindset. I see you there, and I look forward to your thoughts and your questions. And so let's get going. And the first thing is over here is to notice Mr. Wall Street. Mr. Wall Street has his feet in a tub of hot water, Epsom salts. He has a block of ice on his head. He has all these elixirs, as it says on here that it was a rough week on Wall Street. And in fact, this cartoon, as I recall, was first published in the panic of 1907. This was a banking panic and was the culmination of a prior distribution that led to this huge markdown in stock prices and culminated with this panic. And so the idea of distribution is that we can see the signs, the clues of trouble coming, so that we can get out of the way. And for some people, if that's a preference, is to then be able to short stock. And that's a personal preference. But let's go on here and talk about what we're going to cover today. So in our distribution workshop, we're going to, through the course of these slides, and I have more slides than I can cover in the time that I have. I apologize. We're going to talk about the stock market cycle, the role of the composite operator in distribution, how they work, the presence of supply, how to identify it, distribution characteristics that tell us that the composite operator types are at work distributing their stock into the market, how distribution is distinct from accumulation, because they seem to have some similarities, sort of in reverse, upside down to each other, but they are distinctly different. And then we will be doing distribution case studies as we go along, which these are historic case studies, and in future videos we'll be doing more of this in real time. This is a model that Dr. Pruden had developed. I saw this for the first time, wow, 40 years ago, and it was amazing. It took me a long time to really grasp what it meant, but you can see the Wyckoffian influence in his thinking here as we look at the evolution of the stock market cycle, which goes from accumulation to markup and then distribution and markdown. So accumulation must occur by the large informed interests, the really smart people, which in this case are the innovators and the early adopters, and they will accumulate shares. for the big markup. And after the markup occurs, which can take months and years, there will be a conclusion to the markup phase, which will result in distribution, where these large interests stealthily, carefully distribute their stock out into the marketplace before a markdown comes. Now, it's an elusive idea here that we're working with, because we have the early adopters and the early majority which come in and confirm the advance with their buying. So you can see this big bulge in the bell curve of adoption diffusion, where the early majority and the early adopters are accumulating shares, and there's a large participation by these people as the market goes up. But there comes a point where they stop doing their buying and they stop holding stock. Their holding stock is what helps the market to go up, because they hold it, they don't sell it. And that creates a shortage of stock. But what happens is eventually they stop participating in purchases, and this is a point of maximum bullishness. Thereafter, you have divergence, where the large informed interest, the CO types, are they stop buying and they actually are starting to sell. Then, but at the same time, higher prices is really exciting the public, and the public is becoming very interested in the market. And there's all the reasons in the world to own these stocks and own the market when it's up here. There is very few reasons to own when the early adopters and the innovators are buying. Lots of reasons up here. And this is the idea of contrary opinion, is when very few people are interested in the market. At the bottom is when the risks are quite low and there's value is quite high. At the top, distribution area, the risks are quite high. The reasons seem to be present, but the reasons were all being formed earlier in the uptrend. Well, now the late majority and the laggards are buying shares at high prices, which are being sold by the large informed interests. And this is the process of distribution. This is all I'm going to say here, but I'd love for you to study this. It's in Hank's book, 3 Skills of Top Trading, but really, really study this, because there's so much nuance in this very seemingly straightforward, but very important schematic. Okay, another important idea here is the idea of the rising up to the Wall Street Alps. And this idea here is akin to what we just talked about, which is, notice the expert ice wagon. I think this cartoon was penned in the 20s. And so the experts ice wagon. So the experts are saying, get on board, get on board. And these are a lot of the experts that are on Wall Street and so on, that are the fundamentalists, so to speak. And they are giving us all the reasons in the world to get on. And you can see the public here is jumping on the ice wagon. Well, look at here, the modern 16-cylinder methods. There's the composite operator. Here's the insider. Here is the this could be the quants, the algos are in the 16-cylinder machine that's going right up to the top of the mountain. But look at the horses. The horses are exhausted, and they actually had to block the wheel so it wouldn't roll back. And the experts are saying, get on board. It's time to lick up these horses, driver. And there's very little likelihood that the wagon here, with all the public on it, is going to get up to the Wall Street Alps. And so the important idea here is that when the late comers, the late adopters, the laggards, the public gets on board, because there's all this excitement about the marketplace, we as technicians want to be looking for the tools that we can find to tell us that the stock is changing hand from strong holders to weak holders. And the other thing is that here's a cartoon that was drawn back in the 20s. These are truths that have been in place for hundreds of years. This is the way that financial markets unfold, in this cyclic manner. And so cyclicality is not something that has gone away. Cyclicality, as we've seen in the last decade, has been substantial ups, substantial downs, and we're going to look at one of those here in a minute. Okay, so here is our case study, and this case study is the Dow Jones Industrial Average back in 2003. That's where the chart ends. But the period that we're going to look at is 97 to 2003. And we can see here the evidence of distributional character in this chart structure. And we're going to have a much closer look. We're going to analyze this from a Wyckoffian perspective. Below, you can see a distribution schematic. This is a schematic, and I'll show you where you can get these and print them off so that you can put them on your bulletin board next to your desk. And I keep them there. I've been looking at them for 40 years, and I pay very close attention to them, and I'm always learning new things. So they never grow old for me. It never grows old for me to talk about this. So this is just remarkably useful material. So here, let's start with looking at the trend that's coming to the conclusion of this advance. And you can see here, this is a reverse use of trend lines. We draw a trend off this point and this point, and we're going to draw one off this point. That's the way we do it. And look, here we have an overbought condition, a throw over the top of the channel. And then thereafter we have, well, I'm getting a little bit ahead of myself, but here, look at this oversold condition. Beautiful oversold condition, goes through, creates a number of tails, and then turns up, and then has a really beautiful rally upward for a couple of quarters. And then here we would label this preliminary supply. And the preliminary supply is a short stop in the uptrend as it's working its way higher. This one is actually sort of a deep correction in an ongoing uptrend. Here, a little more modest. This is what you typically tend to see with a preliminary supply. And thereafter, we have, this is really important, a buying climax. There's really three parts to this that are important: buying climax, automatic reaction, secondary test. Notice this. Notice the volume that comes in here as we go into the buying climax. Now, I would have considered this to be potentially a buying climax with this throwover, and I probably would have labeled it that way in pencil. I'm always labeling in pencil, so to speak. But here, notice this run up, much higher volume, and actually it struggles to go up, makes a new high. Look at the response to this minor new high. Very sharp decline, very high volume. Supply is present. That should be the conclusion that we draw. Supply is present. Okay, so then we have an automatic reaction that comes right back to the trend channel. Trend is still in force. Secondary test, which cannot even get to the buying climax. Secondary test is to test whether or not supply is present by the ability to get to another new high and keep going up. It can't do it. It doesn't even match the buying climax. So here we have a sideways action and then a break through the bottom of the channel, and thereafter it rides along the channel from below. It's underneath. This is the slowing of momentum. This is a range-bound market. Okay, so as soon as we get a buying climax and automatic reaction, we draw resistance and support. And here we can see that the resistance doesn't really come to play in this example, but support does. Automatic reaction low. This should be an area where demand comes in and drives prices back up again. The concern about distribution is the CO is no longer supporting prices with buying. They are now systematically distributing stock to others. So very large interest, and this is the reason that a market will stop going up, is because the composite operator is no longer supporting the market, campaigning the market for higher prices. They're systematically selling stock, and they will even go as far as to stop their selling as they get to the support area and even do a little bit of buying to help stabilize the market. This has been known to happen. And so here you can see that the other important characteristic that I want to point out here is look at the increased volatility. High volatility off the buying climax. The volatility breaks the support area. Look at this rally in 01. Now, I want to make a point about the present. We've just had a rally of 19% after a sign of weakness in the 2018-19 period, the important rally. And I've heard lots of people say this was too big of a rally for it to be part of distribution or a bear market. This was, and so I would like to just say, you decide. I'm reporting that this was about a 24% rally, almost 23.6 or something like that, rough numbers. But look at the rally. This rally was a rally of greater performance, greater percentage than the rally that we just experienced into March of 2019. And then look at this turn on a dime off of this area and go down very hard into a very important sign of weakness. All right, let's see what we have here. We also draw resistance at preliminary supply. Notice how preliminary supply, that level, stops the advance here in this rally that we were just looking at. And let me do this. And so then we have a sign of weakness. So we label the secondary tests, which are attempts to go up. They do not get to the buying climax. We have a sign of weakness, and we have a rally up to the preliminary supply level, which is formidable resistance. Today, this is about 2,800 on the S&P. And we have a new downtrend. We can draw a downtrend here. We can see a throwover of the downtrend at this place, which immediately fails back below, and there's a huge decline, high volume. The presence of supply is shown not only in the volatility in the decline, but also in the volume. So there's a huge amount of supply present, which shows the footprints of the composite operator distributing stock. Another important advance, this advance is even larger than the prior one. And so here we would label this a last point of supply. After a sign of weakness, we'd say a last point of supply is likely to be next, and that's what we got. We have a major sign of weakness thereafter, which takes out the bottom of the channel, and then an important rally. Look where the rally goes to. It rallies right up to the supply line of this trend channel, touches it without much notice. It turns right off of that and goes down, has a test here in that area right there, and then a total failure. This actually is the end of the bear market. This was about a 36 or 38% bear market. Don't hold me to that. But there is the characteristics of distribution. Another last point of supply after a major sign of weakness. And the other point I want to make here is preliminary supply will often equal last point of supply. So this is a classic place for resistance to show up. We have a touch. This is preliminary supply where it turns the market down. Last point of supply turns the market down. They almost perfectly match each other. Not an uncommon relationship. Look for those. That's one of those little tips and tricks that we'll be talking about in future videos. Okay, and here we go. So the last thing I want to point out in this schematic is there's an upthrust attempt here which we don't actually get, which is a sign of weakness, that we don't get a secondary test, which we would label an upthrust that goes to a minor new high. That's actually a sign of trouble. And then look at the rally in phase B, phase C, how lackluster it is. Well, here it is right here. And this whole area has a downward tilt to it, and is a period where it's very difficult to trade because the volatility is just kind of, you know, crazy, and there's no real long-term trends, even swing trading or short-term trading trends that are available in here. And so this is a period where it's very frustrating, classic phase B behavior. So, okay, let's move on. We don't have a lot of time. I just want to show you this. This is the same period in the NASDAQ composite in 2099, 2000, 2001. Here's your distribution right here. Look at this remarkable upward climactic surge off the top of this upward trend channel, which is a total blow off. And then you have an important distribution area, and this decline was from 5,200 roughly down to about 1,100. This was a massive bear market. This is a case study for another day. Now I want to just bring us up to date on the current situation. Do go back and look at Take the Fork in the Road, which was my Market Watcher live presentation from March 7th, because I wrestle with, is this distribution or reaccumulation? And I'm open to both ideas here. But what I want to do is I want to focus today on the S&P 500 as potentially distribution, and not because I'm calling for that, but because this is what our topic is. And so you can see here that there's this big climactic surge, automatic reaction, secondary test, and here we have the upthrust action. Look at our little schematic. So we have an upthrust action and then a very important, very large decline. This decline back in January, February of 2018 was significant, had a lot of volume in it, showed tremendous supply. Here we have a rally of sorts. It's a pretty good rally, not a great one, and that coincides with this on the schematic. But then thereafter, we have a big sign of weakness with a magnitude larger amount of supply being present. This is something of concern as a distribution characteristic. So this shows that there are motivated sellers that are here at this time. Not uncommon if it was reaccumulation, and that's the discussion we have in Take the Fork in the Road on March 7th. But here, what could happen from here? Here's that 19% advance that we were just talking about. So pretty dramatic rally, which had a lot of short covering in it. And this is the reason why we want to be very careful in distribution, because the short covering rallies can really just destroy the short sellers. It's possible here that we could have another run up, in looking at the schematic, up to an upthrust after distribution. And this could be another higher high. So it's possible that this could be part of a larger move that goes up to a upthrust after distribution as an alternative scenario to the one we just discussed with the 2000, 2001, 2002 market in the Dow Industrials. But if that's the case here, it's possible that one of two things could happen. This could be a last point of supply, which comes up to this resistance area that we're at right now. And we want to be on our toes for that. And we will watch for a sudden turn. We saw that the turns were very quick and sudden in the last example. And then we want to see whether or not the decline shows resistance to going down, whether it's got good support in it, becomes very non-volatile. And again, that's the prior discussion from the fork in the road. But here we want to think about this from the distribution perspective. Can this turn down and then just start to have supply engulfing it and driving prices down to support very quickly? That's what we want to be on our toes for, because this still has the possibility of being distribution. Okay, you can go to this blog, Distribution Definitions in 2015, go into the archives, and you can read up. I would read this piece, and also the schematics are there also. Oh, time for an announcement. Wyckoff, we have a very exciting presentation with a Wyckoff expert. This is Gary Follett, great person, great educator, great Wyckoffian, and a great Wyckoff trader. Worked on the floor in Chicago for a number of years. Well, he's going to do a great presentation on how to trade with Wyckoff principles, and he's going to talk about where you take a trade on the right side of a trading range using Wyckoff concepts. It's going to be very exciting. He's going to talk about current market setups, and it's on March 21st, 5:30 Pacific time. This is a member event, so become a member of the TSAA. It's a wonderful society oriented towards education, and we would love to see you as a member of the organization. Okay, another blog you should read, Take the Fork in the Road. And here, just pause this and mark down these glossary terms that we have for you for distribution. And then finally, we have a Wyckoff market discussion webinar series that we do on Wednesdays. Roman and I do this, and we talk about current markets, current position of important stocks, indexes, sectors, industry groups, commodities. And so we would love to see you join us in these discussions that we have. And then finally, I'm going to just take you to the idea here that we have distribution that can occur on shorter time frames. So these are shaded areas. This was accumulation in green. These are distribution areas. And this is redistribution, which all occurred off of this peak in the NASDAQ composite into the lows made at the end of 2018. And so I want to show you that distribution is something that we can see in a shorter time frame, and for swing trading purposes, and also redistribution, which we'll have more discussion on in future episodes. And then here you can see point figure analysis can be done on these areas. And so the shaded area was the area that we took distribution counts. And you can see here a count to 6,800, 6,350. And also notice the beautiful accumulation count that went right up to the highs. And here is where it went. So these counts took us right down to the area that the comp stopped at the end of the year. And so you can see here that this larger count confirmed the redistribution count, and we went literally 2 entries below and turned right back up, and that was the end of the decline. So on that, I'd like to say thank you for attending this week's episode. We will do a lot more on distribution. We will do a lot more on accumulation. And I thank you for your time and for being involved. And we will see you next time.